Hi, I'm Kunal, and in this video, we'll be understanding how options work in the most simplified manner. So, options generally have an uncanny resemblance to insurance, like how in insurance you pay regular premiums, and on certain occasions or any contingent event, if it occurs, you receive a lump sum amount. In the very similar way, options also work. So, in options, as a option buyer, you generally pay a premium, and in case the event happens, you will receive a lump sum amount from the markets. All right, so that is pretty much simple. That if you understand insurance, the basic terminologies of insurance or the basic working of insurance, you will definitely understand options as well. Now, to understand the entire world of options, you need to understand four things. One is what is long, what is short, and what is call, and what is put. All right, long and short are pretty simple. When you say, for example, buy something in the market, you are set to go long in the market, or it is said that you have taken a long position. All right, and on the other side, if you sell something in the market, you are said that you have taken a short position. So long and short are pretty clear, but the confusion arises when we start talking about call and put. So now let's take an example here and understand call options. So today, say for example, we are standing on 31st May 2023. Today I am entering into an agreement which is giving me the right to buy a particular asset at a particular price on a given date, which is, say for example, 1 month down the line from here. So in that case, I am getting a right to buy the asset at a certain price. Let's put things into perspective and take an example here. Let's say that you are having the right to buy the stock of Reliance at, say for example, 2500 rupees 1 month down the line. All right, that is your right. You may or may not exercise your right. You may or may not actually go and buy the stock of Reliance at 2500. All right, it really depends on the price of Reliance at that point in time. So you are set to go long call because call position gave you this right to buy the asset of a particular stock, but you have purchased such kind of right from the market. All right, that is why you are set to go long call. On the other side, any transaction cannot happen without two parties. All right, so we know that there is a long call and there is a person who has bought this particular option or particular right. On the contrary, there has to be someone who is willing to sell this right to the long call person. All right, so that particular person is known as short call. He's basically giving the long party the right to buy the asset, or say for example to buy the stock of Reliance 1 month down the line at 2500 rupees. Now in the entire arrangement, you would see that the benefit lies with the long party, the person who is going long call, and the short party is basically losing. All right, he does not have any option. He has to oblige to whatever the long party says. Now it seems a very unfair deal to the short party. To make it fair, what we really do here is, at time period 0, when the long party is willing to enter into such kind of arrangement, he has to pay a premium to the short party. So basically the short party is getting compensated for taking this risk, that yes, you can buy the asset, you can buy the stock of Reliance from me at 2500 rupees 1 month down the line. I am giving you that right. Now since I am giving you that right, I am giving you that benefit, you will have to pay a certain premium to me at time period 0, that is today. And that is the whole idea here. And the short party takes the premium home if the person does not come and exercise his right. So this is basically how a long call and a short call functions. Now let's see what would happen when that 1 month passes by and we are on that actual exercise date. Now we entered into the contract on 31st May. So say for example 1 month down the line, on the last date of June, we are seeing the price of Reliance. Now let's again think in terms of numbers, and we'll be able to get an idea how exactly either of the party wins. So the arrangement was for 2500 rupees. All right, the long party had the right to buy the stock at 2500 rupees from the short party. All right, for which any XYZ amount was paid to the short party by the long party. Now say for example after 1 month the stock of Reliance is 2600. In that case, what would the long party do? All right, if you apply a little bit of common sense, you'll get the answer here. The long party had the right to buy the stock for 2500, and in the market right now the current price of the stock, that is say for example Reliance, is around 2600. All right, so the person is very likely to exercise his right. Why is he very likely to exercise his right? Because he can buy the stock at 2500 rupees and sell it for 2600 rupees in the market, making a profit of 100 rupees less the premium that he had originally paid at time period 0. On the other hand, if you look at from the perspective of the short party, he would basically have to oblige and give that stock to the long party. So whatever the long party gains, the short party loses. Now let's take any other number. Let's say that the stock price of Reliance after 1 month was 2450. Alright, so since the stock price of Reliance is 2450, the long party would not be willing to exercise his right to buy the stock of Reliance for 2500. मतलब मार्केट में 2450 का मिल रहा है तो मैं क्यों कॉन्ट्रैक्ट में 2500 का बाय करूं. Alright, so it is pretty simple that whenever the price of the stock, that is the current price or the spot price as you can call it, is above than the exercise price, that is when the long party would exercise his right and ask the short party, please give me the stock, I want to exercise my right. In case if it is equal or less than the exercise price or the agreed upon price, the long party would say that I do not need to really buy it from you because the price in the market is equal or lesser than what you are offering me for. Alright, so the long party would not be willing to exercise his right. So the whole idea is pretty simple. Long party gains when the price of the stock is beyond 2500, that is beyond the agreed upon price, and the short party gains when the price is lesser than 2500. Now, how much the long party or the short party could gain from this entire arrangement? The long party can gain an infinite amount of money. Reason being, the stock price can go as high as 10,000, 20,000, 30,000. There is no upside limit to the stock price. So, whatever the stock price is, say for example, if it is 20,000, so he'll exercise the right to buy the stock at 2500 and sell it in the market for whatever XYZ, say for example, we spoke about 20,000 or 25,000 for that matter. Alright, so there's no upside limit in terms of profits for the long party. And likewise, the short party does not have any upside limit in terms of losses. Alright, जो भी long party का profit होगा वो short party का नुकसान हो जाएगा. In terms of the profitability of the short party, he'll only gain when the price is below 2500 or equal to 2500. Now let's say the price can go 2200, 1800 or maybe 1500, but it does not matter as long as it is below 2500, the short party would be gaining here. So that is how the entire arrangement works. In terms of call option, generally the buyer of the option gets the right to buy the asset, and in terms of put option, which we have not discussed so far, the buyer gets the right to sell the asset. Alright, so it works in the exact opposite way as it worked in the call option. So what I would like you to do here is understand put options and how it exactly works. Think it from a perspective of long put and short put. Again, long put gets the right, or he's buying the right to sell the asset, and the short put, is basically selling the right to the long party so that he could sell the asset if he wants to. So that is how the put arrangement works. Now we need to understand that how we understood the call option. Basically, we need to take an example here, put it across in terms of numbers and get the idea and see how it works out. And once we are clear with that, we'll know what exactly long call option is doing in the market, what exactly a short call option person is doing in the market, and likewise what exactly a long put or a short put person is doing in the market. So that is how the basics of options work around. Understand these four main positions and you'll be very much sorted with your options trading journey, or at least the beginning of it, given that you understand these four basic terminologies completely. So I hope you enjoyed this video, and in the upcoming videos we'll be talking more about how option pricing works out, how the premiums are calculated, and what are the different strategies that people use using these four positions. Remember, there cannot be any strategy made without the use of these four positions. Alright, there's no other positions in the market. There has to be these four positions, and based on this, the strategies can be made. So once you are clear with this, you'll be able to make the strategies along with me as we move ahead. Thank you.